All right, what is up, traders? What's up, tycoons? Super excited for today's video. We're seeing Google dropping hard in the after hours. We have Microsoft popping. Both of these just reported earnings. It's a huge earnings week for the stock market. Lots of stuff to talk about. We're going to talk about the daily chart for SPX and take a look at some of the different possible paths and scenarios that we just went over in the Discord. All right, lots of really good data we're going to cover in today's video, such as government interest payments. All right, absolutely insane stuff there. And then we'll talk about how this rally actually has been historically weak. We're going to take a look at some data to kind of enforce that thesis. And then, of course, we've got to talk about, gold and energy due to the geopolitical risks happening, in the Middle East. All right, and then we'll talk about some data that potentially suggest, the end of year rally, and we'll really break down, why we could get that according to some of the data. All right, so we're going to break down a lot of that in today's video. We're also going to talk about households and where households are putting their money. There's some really, really interesting stuff I found out about this that I want to bring to y'all's attention. I think y'all are going to really enjoy the content. So as always, though, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. If you're new to the channel, I started a completely free newsletter for y'all called Investment Intelligence, giving out free trade ideas as well as free valuable finance content. And this is what the trade ideas will look like, right? Highlighting some of the conditions and the chart that we're looking at. You can see that trade played out very nicely. We have a rising wedge here on SWK, again, highlighting some of the key levels that we're targeting. And that trade also played out very nicely. So if you want to join the Discord where you can get access to all of the trade ideas, there is a link to join the Discord in the description down below. Okay. But otherwise, you can just sign up for the free newsletter. If you ever feel like you need a little bit of one-on-one time, okay, I have a Ko-Fi page right here, ko-fi.com. And you can sign up for 30-minute and 1-hour one-on-one sessions. That's where you can directly book a session with me, and we can work on getting one scheduled together, as well as request a YouTube video on the topic of your choice. And you can also click on this buy a coffee button if you ever want to leave a donation or like a tip basically for the free valuable content I put out. Now, let's go ahead and get right into it. And let's start off here with the U.S. government bond interest payments per day that doubled from $1 billion per day before the pandemic to almost $2 billion per day in 2023. Remember, this is just their interest payments, right? And the government is literally spending billions of dollars a day just on interest. Absolutely insane, especially when you consider all of the money that we're sending overseas right now too. We're just the US just has a massive debt problem, and the economy seems to keep chugging along, but a lot of the bears will tell you that this cannot happen forever and cannot continue forever, and potentially a huge disaster could be coming, right? Now, when you take a look, and why am I saying that the rally has been historically weak? Well, if you take a look at the S&P 500 return progression off of bear market lows from 1957 to now, okay, the current rally is only up basically 20%. And typically after a full year, okay, which we basically bottomed in the S&P 500 last October, you're up. The average is 39% and the median is 33%. So you can see that that's why historically this has been a weak rally and a weak recovery from the bear market. Now, the SPX is up around 20% since its October 2022 low, making it the fourth slowest start to a bull market since 1932. So I showed this chart on the last video, but I just wanted to revisit it and kind of dive a little bit deeper into it. And so the analysis basically indicates that year two following a major low has been positive 19 of the 22 cycles. So, next year, okay, historically, we've been green 19 out of 22 times. Okay. We're talking about year two after the major cycle low. So we just finished year one, and then we're talking about year two. But this is the fourth slowest start to a bull market since 1932. So this data goes back a little bit further than the previous chart that only went back to 1957. Now, this is some more data just kind of emphasizing the weak start to a rally. We just passed the 1-year mark for the S&P 500's October 2022 low, yet only 2% of members are making new 1-year highs. It's vastly different compared to bear markets that ended in 2002 and 2009, when over 20% of members were making new highs. So this is the percentage of members with new 52-week highs, and you can see how low that is compared to the times in 09 as well as 02 over here. And we're just, this is not screaming bullish at all necessarily, right? Not really a lot of stock making new 52-week highs. Now, when we talk about the geopolitical risk hedges, all right, gold miners are trading on the cheaper valuations, but the energy sector ETF assets outnumbers that of the same for gold miners by more than 3x. So this is the oil versus gold price to book ratio. Okay, you can see that these typically trade very similar, okay, and move pretty similar. But when you look at the gold miners right here, it's at a much cheaper valuation. And then this is the ETF assets under management, and you can see the energy sector is, just getting lots more inflows, right? There's a lot more assets under management when it comes to energy versus the gold miners. Now, people don't always go into the gold miners. Sometimes people actually just buy physical gold. Sometimes people just buy, gold futures. There's different instruments, okay, or an ETF like GLD versus the gold miners. But we're kind of just highlighting the miners here at this point. Now, we've seen a significant jump in Chase card spending data to kick off the seasonality strong Q4 shopping season, right? Shopping season is here. Holiday season is here. Okay, people start buying, all of their Halloween costumes, Halloween decorations. Then you've got Thanksgiving, right? And so you're going to see a lot of spending at the grocery stores, also decorations. And of course, you've got Christmas and, the other holidays that people celebrate towards that time of year, like Hanukkah and stuff. Shout out Kwanzaa, right? I believe Kwanzaa is the thing. Credit card spending, yes, that means the consumer is going more in debt technically. Okay, so it might not be the best thing for the economy, but we're starting to see that uptick that we should be seeing from Chase. Now, inventories versus ISM, the positive turn in the inventory cycle also signals an upswing in manufacturing activity. So that's what we're looking at right here. We have ISM in the blue, and then we have manufacturing and trade sales to inventory ratio here in the red. All right, and we kind of just explained, what it is that we're looking at right now. You see here that history suggests U.S. equities typically rally following peak hawkishness if the economy avoids a recession. And I definitely say that if we're not getting peak hawkishness right now, sorry about that. That was the opening market bell right there. But if we're not getting peak hawkishness, the economy avoids a recession, we typically see a strong rally. Okay, and so you can see the how the S&P 500 is, all right, and then this is no recession within the subsequent 12 months. So if it's possible we do get this soft landing, okay, you can see how this chart has been kind of lining up with this up here until recently. The market basically topped out earlier this summer and has been in a downtrend ever since. But there is a dip period right here, and if we can avoid a recession next year, all right, it's very possible that we could see this nice rally over here. Now, when you look at ISM versus EPS, and the recent improvements in ISM manufacturing point to a positive earnings outlook. Okay, we just had a couple big earnings. Microsoft looked really good. Google beat, okay, but they largely fell because of the cloud. The cloud was kind of disappointing. All right, but S&P 500 earnings, the outlook does look brighter, especially off of this data set. When you take a look at both 2023 and 2024, consensus earnings per shares have stabilized. So we've got 2023 in blue, we've got 2024 in green, and then we've got the historical average there in blue as well. So the dark blue is 2023, and then the lighter blue is the historical average. All right. And so, we're seeing them start to stabilize, right? They're not really much more in a downtrend. They could be in a bottoming process where you would start to eventually see these actually start to tick up, right? I mean, they're in a shorter term uptrend, but, we can't really say that they've completely broken the downtrend. They just kind of are stabilizing, as we mentioned. Now, forward margins appear to have troughed in April, and consensus expects a recovery into 2024. So, we can see how the forward margin estimates have fallen. Okay. But they're appearing to trough right here at this point. So this is what we're talking about here with the trough. All right. And they're still projecting a rebound in the second half of 2023 and 2024. These are the consensus projections right here. And again, you see them ticking up here when you look at LTM net margin and LTM EBIT. All right. So again, a little bit of some bullish consensus data. We're trying to go over some bullish things and some bearish things for you guys so you can see all sides of the data set, not just one side. Now, we want to talk about households, okay? And so what I mean by that is basically you and me, your average retail trader and household participant that, invests. All right. So when you take a look at households versus stocks and bonds, households own 9% of outstanding US Treasury bonds. This is up from just 2% at the start of 2022. So in 2023, we've seen basically a 3x in the amount that investors are holding when it comes to US Treasury bonds, right? So this is it right here. You can see households at 9% at the ownership breakdown of the US Treasury market. Now, what's really crazy is that households are the largest owner of US equities at 39%, right? So when you look at the breakdown of US equities, right, households, again, so retail, people like, you and me, we own the largest amount of stocks out of everybody, right? So there's a couple ways to look at that. You could say, hey, well, maybe, big money knows something that we don't and that there's a big crash coming. Or you could say that, wow, if things really do go bullish, there's a lot of money that we know from mutual funds, from invest institutions, all of these different type of instruments, right? Financial instruments. A lot of that money could come flooding into the stock market and flooding into US equities and push things up further, right? So there's a couple different ways to interpret it, but I just wanted to point that out to you guys because it's really interesting in my opinion. Now, when you talk about aside from treasuries, households have purchased $448 billion in money market mutual funds through June and sold only $168 billion of their $40 trillion in corporate equity and mutual fund positions in the first half of 2023. So you're really seeing, households getting into treasuries. You're seeing them get into equities. You're seeing them get into money market funds as well. And there's lots of reasons, right? Stocks were at a very large discount, in the beginning of the year. All right. And then, treasury yields are finally attractive once again, especially with the yield curve being inverted. You can get really nice yields on short-term, treasury bonds or treasury T-bills, things like that, 3 months, 6 month, 1 year even. And, not just you don't only have to look at, far out maturities, and, such as the 10, 20, 30 year to actually get a decent yield. Now, households already heavily invested in equities. Their current 42% allocation to stocks ranked in the 96th percentile since 1952. The bond allocation equals 17%. This is the 46th percentile. And the allocation to cash is low versus history at 16%, which is your 25th percentile. So, basically the whole thing that I want to point out here is that cash, right? People are realizing that, hey, I can actually put my cash to work right now, right? And that's why we're seeing the allocation to cash being historically low, even though things aren't so certain in the bond market, even though things aren't so certain in the equity market. People are realizing, hey, well, I finally got somewhere to put my money. The stock market, I'm not buying all-time highs in the stock market. I can put my money into treasuries or money market funds and actually get a good yield on my cash. So, that's one positive we do have for households and your average household investor. Now, Treasury Tick data shows that during the past 6 months, foreign investors have bought U.S. stocks at the fastest pace since 2021. They forecast foreign investors will net buy $150 billion of U.S. equities in 2023 and an additional $100 billion in 2024. So, we're seeing lots of buying from households. We're seeing lots of buying from foreign investors as well. And we just don't see that large participation, it seems like, from institutions in the US. All right. So I just think that that's pretty interesting. As I mentioned, there's a couple ways to interpret that. Maybe we've all got it wrong and a huge crash is coming, and institutions know this. Or if institutions have it wrong and they need to chase the market, right, there's going to be a lot of money coming into the market that could potentially push it higher and further fuel the rally. Now, this is Google. Okay, we talked about Google. Google's dropping. I just dropped a chart in the Discord. Google has many gaps down to fill, right? Most likely, it's going to try to attempt the gap around 125. But there's further gaps down to fill as well that potentially Google could be heading for. Microsoft will have to see how it actually ends up trading. If this is just going to be a gap and go and continue bullishness, we'll have to see that. Or if this is going to be a reversal, basically a failed breakout with the gap, and then we come back down and end up filling that gap. We'll just have to see how that plays out. Ultimately, for the S&P 500, when you take a look at the SPX daily chart, the trend is very clear right here, right? I mean, we're clearly in a downtrend, right? We're making lower highs, lower highs, lower highs, lower lows, lower lows, lower lows. The question here is this actually trying to form a bottom, right? So we posted in the Discord this chart right here. So, saying, hey, we're probably going to get a bounce up here. The big question is this just a bounce, a dead cat bounce to continue going lower? If we break through 4195 to about 4200 on the SPX, it's very possible our next target is going to be right around 4100. For us to really get into an uptrend, we need to break this trend line here, and we need to fill the gap up around 4400 on the SPX. If we can do that, that's when we can potentially start making a new trend of higher highs and higher lows. Okay, but for now, the trend is still intact in the downtrend. And I always try to remind people cash is a position. You don't have to be all in on the market during times of uncertainty. You don't have to be all in right before earnings season. And this week we're having a huge earnings week with many of the top stocks in the S&P reporting earnings. We just showed Google and Microsoft very different outcomes, right? One raged to the upside and one crashed to the downside. Right. And, if you're not prepared for those type of things or properly hedged, a lot of times you can make bad judgment calls because you're simply just panicking. Right. So ultimately, we should know, relatively shortly, right, if we're going to be continuing this downtrend and continuing to make lower lows, or if we're going to be potentially trying to make some higher highs here and try to break out of this downtrend. That's it for today's video. Don't forget to sign up for the newsletter, completely free, giving you guys, free valuable content as well as free trade ideas using the link in the description. Right, you can join the Investment Intelligence Discord to get access to all of the different trade ideas. There's a link in the description for that. And, you can head on over to the Ko-Fi page, click on commissions here, where you can book a 30-minute or 1-hour session if you feel a little bit like you need a little bit of some one-on-one time, just to kind of go over things. And, sometimes people can't always learn just from watching videos or reading. Sometimes they feel like they need that extra interaction, right, from a one-on-one session. So I'll be happy to schedule a time on that, that'll fit both of our needs.